Okay, interpret the scribbles. So difference between profit and cash. Profit and cash is a huge area of accounts, and anyone who's been taught by me knows I will ramble on a lot about profit being different to cash and why I prefer to focus on cash flow because you can't pay your bills without any cash. Profit is fine, it's a paper exercise, it's how you performed last year, but it applies the accruals concept and lots of other concepts to make sure the figures match. And it makes sense and it's logical. There's a reason to do it because you need to know how you perform year on year, but at the end of the day, you can't pay your bills without cash. And so for each transaction, there will be a different impact quite often on profitability or cash flow. And so if this comes up, they had a 8 marker on difference between profit and cash last year. It was particularly awkward. They've also had a 14 marker before where you've had to work out profit and bank, which is slightly similar to this one. And so what we've got is 6 adjustments, and what you've got to think about is where they would sit in the income statement or where they would sit from a cash flow point of view. So at the top, I've put that profit after all these adjustments will be 32,200 and bank will be 11,000. Going to say if this question comes up, can you just be clear, put things in brackets, minus, add, show the examiner that you understand whether something should be added or take away. If you just do a list of numbers, you'll just saying you're adding them all and they won't all be added. You've got to think about the examiner and how they're marking your question. Anyway, the first adjustments for a bank loan. Now, the other thing to note is the following 6 items have not yet been accounted for. So you've got to make sure you consider that. And yeah, it's part of it. But this is for the year ended 31st of March 2026. So on the 1st of January 2025, we took out a loan for £20,000, which is going to be repaid in equal instalments over 5 years. The interest is charged at 8% per annum on the balance outstanding at the start of the year. The first capital instalment plus the interest for the year was paid via standing order on the 31st of December 2025. So, I mean, obviously, when we originally got the loan, that would have actually hit the 2025 cash flow, but we're in the next financial year, so that part isn't relevant. So what we're looking at instead is what would go in the income statement and what would go in the cash flow for a loan. Now, please, 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 the loans. The only thing that hits the income statement is the repayment of the interest. From a cash flow point of view, it's whatever we actually have to pay money for. Logical as that. That's what you've got to be thinking with cash flow. So from an interest point of view, it's an 8% per annum. So we've had the loan for the whole year. 8% of £20,000 is 1,600. So we'll take £1,600 off profit. It's said that the loan's going to be paid in equal annual capital instalments over 5 years. Well, 20,000 over 5 is 4,000. So every year you're going to be paying £4,000 off the capital of that loan. We are paying £1,600 of interest for this one. So £5,600 is going to be the cash outflow. If we go for an asset disposal, and so again, so we've got an asset that we've sold. We've got to think about for a profit and loss point of view, it is just the profit and loss and disposal. From a cash flow point of view, it is just the proceeds. So the fact that we sold an old van for £4,200 cash means that that's added to cash flow. Done, easy. However, from a profit point of view, we've got to work out if we made a profit or loss. So what we do is we work out the net book value of the asset, and then we compare that to the cash value. So the van originally cost £12,000. At the start of the year, its accumulated depreciation was £7,000. So we work out the net book value. 12 take away 7, £5,000 net book value. We sold it for £4,200 cash, so therefore we sold it for £800 less, so that's an £800 loss on disposal, so we're going to take that off profit. It's important that last line that says there's no depreciation in the year of disposal because sometimes you'll have monthly depreciation, so that could be an impact on profit if you had to calculate the depreciation up to and including the date of disposal. Irrecoverable debt recovery. A cheque for £900 was received from a customer whose debt was written off 2 years ago. So we circled that 2 years ago. The irrecoverable debt hit our accounts 2 years ago. We can't do anything about that, so we can't reverse that. But either way, a £900 irrecoverable debt recovery or recovery of an irrecoverable debt, if we want to just make it even more annoying to say, will increase profit because we'll record that in any other income, the 900, and we've got a check, we've got money, so therefore we've got £900 extra in the bank. When it comes to depreciation charge, so our motor vehicles depreciated 25% per annum using reducing balance. So the first thing, method mark, working out the net book value. So 40,000 take away 12,000 is 28,000. So we've got a £7,000 depreciation charge. That will reduce profit. So we're going to take £7,000 off profit. Hopefully, you know that depreciation is a non-cash expense. When we originally bought the motor vehicles, that would have hit cash. Right now, non-cash, not there. Inventory valuation. So what we could have and is to adjust our inventory valuation because of some issues. So following prudence concept, if we've got some items which are net realizable value is lower than cost, well, we've got to value them at the net realizable value. So closing inventory was included at a cost of 21k. That included 400 units, which cost £5 each. Those units are now damaged and could be sold for £3 each, but the business must pay 50 pence per unit to make them sellable. So we have to take the 50p off the £3. So they will be the net realizable value is £2.50. They cost us 400. We compare the two, and we can see that we would lose £1,000 worth of value because of that. Inventory being worth £1,000 less would reduce profit by 1,000. So you're going to take that off profit as well. There's no cash impact. Hopefully you can see that. If inventory is worth less, there's nothing to do with cash flow. That just means we've lost the value of our inventory. Finally, we purchased some new equipment on credit, £1,500 on credit on the 1st of December. It doesn't say we paid it yet. No cash flow implications. The business depreciates at 20% per annum on cost, applying the full year's depreciation in the year of acquisition. So there's no split months. So we just do 1,500 times 20% is £300. So again, that's depreciation. Again, that reduces profit. So a few little adjustments. Think about lots of different adjustments and how they would impact cash and profit differently. So how you pay suppliers, receive payments from customers, irrecoverable debts. Just think about, are we spending money? Are we receiving money? Okay, good luck.